So let's start tonight. We're going to do this debate about, or not debate, but discussion about term versus whole life. It gets complicated after this debate because then you had universal life, variable universal life, all these other products. So we're going to assume, since I know I hate those other products anyway, that the debate is between term and whole life, and not just between term and whole life, but level term. So like 10-year level term or whole life. Which should you purchase between the two? And so this guy, Art Williams, he's out there on the internet. He's got his own Wikipedia page. And you'll see the discussion about buying term and investing the difference. That's the thing he made famous. This Wikipedia says term wasn't very popular in the 70s. Everybody was buying whole life. I don't think that's entirely true. Term did have its place. I don't know when level term became really popular. But he started this business and radically changed the industry. Now, I think he has some serious legal problems that aren't in this Wikipedia page at all. So, I guess you can clean up your own Wikipedia page. It's not in here. But he did have quite an impact. He was a wealthy man, so you can see he owns some smaller sports franchises. I don't see that he's passed away, so he's 80 years old, still around, very wealthy. I don't know his relationship with Primerica anymore. Primerica, it's the firm he started, and part of this wasn't just buy term and invest the difference, but also his sales force, a very heavily commission based sales force, very strongly pushed to sales, and it was a very, very effective sales force. So that's the side of buy term and invest the difference. So what is he saying? Level term is much cheaper than whole life, but it only covers you for like 20 years. But since it's much cheaper, if the premium is $50 instead of $300, take that extra $250 and invest it in something. And after end of 20 years or whatever, you'll be better off. We're going to look at the actual math behind that. But that was his argument, buy term. Have any of y'all heard that phrase before this class? You heard it, Jay? So it used to be real popular, but now with Universal Life and all these others, it's not as well known. So I went to his website and I got his arguments for why to do that. So I just cut and paste his arguments. And then, like I said, from the textbook I had that is very pro whole life and industry, I took their arguments and listed them. And some of them are just the counter to the other side. Now, y'all can guess where I'm stronger on this, but I do think there's a place for whole life. While I don't like universal life, variable universal life, I do like whole life. I do think it makes sense, but I do think for most people, buying term and investing the difference makes a lot of sense. So what you have to do on this is somehow organize this into a logical, cohesive argument. And it can be a little tough because there is you're kind of back and forth. But let's start with their arguments. I think I did it in the same order that he had it on his website. It may be interesting to see if I haven't looked at Primerica. Have y'all heard of Primerica before? Yeah. Have y'all met Primerica salespeople before? No? So if you go on their site, yeah, they got quite a bit going on here. Term life, you notice there's no other life insurance in there. What I really dislike with this firm is their investments, I think, are incredibly expensive. So, when we say buy term and invest the difference, you can buy term and invest the difference not with Primerica, with somebody else, which can make a whole lot more sense. But what were they selling? Buy term and invest the difference with us and our high expensive mutual funds. So, but it kind of contradicts their first argument, which is there's no reason to combine life insurance with your investing side. No reason to put those two products together. If you need life insurance, buy life insurance. And invest. There's a textbook over in the UTSA library. I should go see if I can find it. It's an old textbook, like back from the 50s. And they're arguing against whole life insurance. And their argument was, what if you bought auto insurance and they say your premium's 150, but you need to pay 400. And you say, well, am I paying 400? Well, the 150 is for the auto insurance, but 350, we're just going to set aside in a savings account for you. Say, okay, I have to do that. Yeah, you have to do that. That's the product. It's got a life insurance. It's got a savings. You say, okay, that's fine. And your savings builds up $8, $9, $10,000, $12,000. And then a few years later, you have an auto accident. It costs $15,000. And they pay your claim. Say, well, that's nice. And then you look online and your savings account's now zero. You're like, hey, what happened to my savings account? Well, we use that to pay your claim. It's like, well, wait a minute. I thought you said I had auto insurance. I said, no, but we get to use your savings account to pay the claims. That was the argument he was making for why this doesn't make any sense. Why would you combine those two and then let them use your money to pay you when you have a debt? Now, obviously, they're using your money so it keeps the premium lower. But at the same time, that's what happens with whole life. When you die, you have a $100,000 policy. If your cash value is 40, your cash value disappears and they give you the 100. So they only paid 60 and they use your money. And that's what he's arguing. And that was back in the 40s, 50s. I don't know exactly the date. It was an old book. So Art William didn't first think of this. There was other people who do not like this whole life. And so that's the first thing. Why combine two things? You don't do it with auto insurance. You don't do it with homeowners insurance. Why would you do it with life insurance? You don't do it with health insurance. So why would you combine these two? That makes some sense. The second one is kind of obvious. It's the lowest cost when you're young because all you're doing is buying insurance. So it's low cost because you're not making the investment piece. That's kind of obvious. And then the third one kind of is obvious as well. If you're buying term that's only $50, then obviously you have more money to invest than if you bought whole life. You have an extra $250. Now I put an editorial in here, which is kind of confusing. And we'll get into that when we get the other side. What did 80% of Americans do that bought this argument? They bought term and did what? They spent the difference. So what happens when 20 years later, they have nothing? At least with the whole life, they would have had something. Now they have absolutely nothing. So the majority of people who bought this argument bought term and spent the difference and did not have the savings element. You have more control over your investment program. Now that's the piece that all this universal life and variable universal life has essentially killed. Because remember, with especially variable universal life, you can stick that money into whatever you want to, in the stock market, bond market. So the life insurance industry has somewhat offset that. Some people used to argue, and you'll see this in the next one, that, well, Americans can't do that. They're not well trained. I should really strike that one out because today with mutual funds, it's easy to hire a professional investor. You don't have to be real trained. So I should put a comment. So with universal life, variable universal life, they do have control over investment program. They can invest in mutual funds that the life insurance company offers. All right, you understand that argument. That argument is probably the weakest because of variable universal life. But this first argument, which the textbook I saw had, I don't think it. This is a weak argument. It's very easy, very easy to find professional managers today. Especially if you're smart and you just go passive, you can just go to Vanguard and you're done. You don't really need to do much work. All right, this next one I think is a strong argument. Why are you buying insurance? We already talked about that. It's to cover human capital. When do you have your most human capital? It's when you're young, in your 20s and 30s and 40s. You don't need life insurance, supposedly. We'll talk about that. Supposedly in your 70s after you're retired because you don't have any more human capital. Now, we're going to say that there are some reasons for having life insurance in those later years. But that's a strong argument. So when you have dependents, he didn't put in the human capital. I would add the human capital. Because if you're buying life insurance as a hedge against human capital, then you need it the most when human capital is the greatest. The next one I really, really like. Level term is simple. It's very easy to compare that product to other products. You just buy the cheapest one. Even with whole life, there's some extra bells and whistles that can make it a little bit tricky. The cash value, you don't know what it's going to build up to over time. There's some things that make it a little more difficult. This is especially true though when you're comparing it to universal life and variable universal life, those really complicated products. Level term is so easy. You just pick the company with the lowest premium. Very, very, very easy. The next argument he made is, hey, if you need money, you take it out of your investment program. There's no reason for that to affect your life insurance. I don't like that argument because it's really easy to borrow against your life insurance policy, and we'll talk about that. It's actually, I think this argument is probably the weakest and probably the strongest for whole life. If you have a whole life policy with a cash value, it's actually quite easy to borrow money from yourself. Doesn't create, and we're going to talk about the tax impact. What he's saying here, if you withdraw money from your investment program, you're going to have a tax, you're going to have to pay taxes, especially if it's a retirement program. You may have a 10% penalty tax for taking money out. If you have a whole life insurance policy with a cash value, you can borrow against that, and there's no tax implications as long as you pay it back in time. The IRS doesn't charge that penalty. So I think this to me is a weak argument because it creates tax issues you don't see when you're borrowing against life insurance. This next argument has gone away, but at the time he started this company, whole life paid really, really low interest rates when interest rates were high. That's no longer true. Remember, universal life came along and has much more competitive rates, and whole life today is more competitive rates, not as competitive as universal life, but more competitive. The other argument you can make here is the reason whole life had such low rates is it was very low risk. So yeah, you could put your money in the stock market, make 10%, but you could also lose 40%. With whole life, you're making 3-4% without risk. And then this goes back to buying it when you need it. If you buy life insurance for whole life, you're paying for insurance during the period of time you don't need insurance. After you've retired, you no longer have dependents, you no longer have human capital. So that makes it a very expensive insurance because you're buying it for when you don't need the insurance. So those are the arguments. My editorial comments I probably shouldn't have put in there because I think it confuses it, but I just put them through in there so you can kind of see the thoughts. So these are not from their website. Their website are these 9 points. The most important one to me is that one. I think the fact that insurance is trying to make these really complicated products, especially even past whole life. Whole life is not too bad because you do kind of just take the lowest premium, but life insurance is getting more and more complicated to the point where you really have no hope of knowing which is the best product. I can't imagine level term being a difficult product for most people to buy. Most people will understand that without any trouble. So that's a strong argument. So I wish I could find how money works. I'm not sure which one of these is. It's probably under term life. So they say is pure protection. It's kind of the hint that, like fire insurance, like auto insurance, it's protection. It's not an investment. So there's someone hinting at that now. It's the least expensive option, especially if you're young and healthy, obviously. Find a representative. I don't want to click on that or I get 1,000 emails. All right. So what did the textbook that I had, what did it argue? And so their first argument was, yeah, it's true, whole life had really low rates, but they're very low investments. Insurance companies are buying bonds. So that's not an issue. The problem with that is we're talking about young people in their 20s. We already talked about this earlier with your paper one. Young people should have a lot in the stock market because they're young. Their human capital is like a bond. So they shouldn't have a conservative bond-like investment. That argument really doesn't make sense. So y'all know what MPT is? Modern portfolio theory. I love all the stuff we have is modern, and now we're postmodern. Now, I don't really know what postmodern means, but modern portfolio theory is from the early 60s through still around today. So it just argues that, yeah, a young person should have a heavy allocation to stocks. The second one, I think, has some credence that there are people that do need coverage later in life. If they bought whole life early in their life, they have something. They'll probably just out of habit keep paying the premium, and at least I have something. That's kind of my parents' situation, although they messed up and bought universal life. But if they bought whole life, it would have been absolutely perfect. Something in place during that time. We're going to talk about if they had invested a difference, they probably wouldn't have needed it later in life. All right. So that's kind of the contrast here. And this argument, I don't think, again, makes any sense, is most individuals can't manage their own investments. They need a professional. Yeah, you can go to a life insurance company and put it in a whole life and they'll manage it for you, but you can go to Vanguard and buy a bond fund or a stock fund. So I don't, that's not, and in fact, I don't know if y'all know lifestyle funds. I tell a lot of people, just go to Vanguard and buy a lifestyle fund. It's going to save you a lot of money, a lot of time. It's simple. They're going to do exactly the same thing that wealth manager charging you 1% is doing. They just won't charge you the 1%. Yeah, the investment world's actually done a pretty good job. Thanks to Vanguard. Pre-Vanguard, we were horrible, but thanks to Vanguard, we have some very low costs, very good investments that most individuals can handle without much analysis. You don't need a life insurance company managing for you now that we have the investment world. Liquidity, I talked about this one. This one I do agree with. It is easier to borrow from a life insurance policy than it is to take money out of your mutual fund. I've never borrowed against a life insurance policy. I just assuming it's easy. There's a department that handles that and take phone calls. Now I'm pretty sure it's online. It's probably pretty simple to do. I don't know how many days it takes to get the cash, but with a mutual fund, it can take quite a bit, 3 or 4 days with a mutual fund as well. So it's probably about the same speed. The biggest thing here is it's tax-free or non-tax inducing. I don't know what word to use, but it doesn't create a taxable event, unlike your investments almost always will create a taxable event. Bill Gates doesn't like that, but and especially with retirement plans, it's not just tax, but it's penalty tax. So it's income tax plus an extra 10%. This next one, I think, is the strongest argument on the permanent side, is this idea of forced state savings, especially with whole life. With whole life, you have to pay the premium. You have to buy the insurance and the savings piece. You have no choice. If you stop doing that, you lose the insurance. It's great discipline for people who just pay their bills every month. How do most people pay their life insurance, do you think, today? Do they write checks? An automatic withdrawal, right from their checking account. They don't even think about it, it just comes right out. I kind of like, the gym membership. Haven't been in a gym in 13 months, but that $40 comes out every month. People just forget about it and just goes. And then years later, it's like, hey, I have this life insurance policy. This is pretty cool. So it's forced savings. People aren't financially disciplined. Permanent insurance at least provides them some. The mutual fund industry has tried to address that with these automatic withdrawals from your account. Obviously, 401k plans. There's a lot of things that we're doing to try to make it more of a force. The problem with the life insurance industry is it's moving away from this. With these universal life policies where you have the choice that you only have to pay the cost of insurance, you don't have to pay the investment. In a sense, the insurance industry is saying, well, let's not do forced savings. Let's let them avoid the investment. That's a pretty kind of big departure. And this last argument I think is true as well. I mentioned that we might need life insurance well past the time our human capital stops. It could be for estate planning. It could be money for the surviving spouse, those type of things. It can make some sense. But then if you invested the difference, you'd be covered. You're not going to buy term insurance when you're 60 years old. It's just going to be way, way, way too expensive. So at least you have something. All right, so how do you organize that into an exam answer? You know, you might word it and come by and talk to me and just see, you got to somehow get those thoughts in there. Can y'all think of other arguments? So if you buy the argument, you don't have to buy term from Primerica, and you don't have to invest with Primerica. So that's kind of the conversation I want to have is, hey, great idea. I love your idea. I'm going to call some insurance companies and find a policy that are like, no, buy from us. Primerica historically has had horrible rates. They may be much better today, given their Travelers and Citibank experiences. It would be interesting to compare. I'm scared to go into Primerica to compare because their salespeople are pretty aggressive. I have people calling me right afterwards. But it would be interesting to compare the rates. I don't know if there is a, Allstate has their site that you compare auto insurance between different providers and Esurance and those kind of places. I don't think there's a place like that for term insurance, but it would be really helpful if you could compare policies between companies, but just call several companies. So even though you buy the argument, you don't have to buy from Primerica, but given his sales force, he was really strong at that. But let me show you the bottom line of this is, first of all, the industry with these unbundled products and variable products, essentially they're selling the insurance and the investments from one company. They're telling you, hey, you can separate them but buy them all from us. That's a horrible argument. You should buy the life insurance from the company with the best life insurance and buy the investments from the company with the best investments. There's no reason to combine those two. So let's just stick with level term versus whole life. All right, just those two policies. And let's look at these. You have to draw these on the exam, so you got to figure out how to do this. And my friend Ken, he said, okay, I got to make this choice between whole life and term. So you have to draw this on the exam and you got to explain it. All right. I've had some students that just drew this on the exam, like this one line. It's like, okay, thanks a lot. Well, what's the axis? You got to tell me what the axis is. All right. So what I did for him is I said, oh, let me take the whole life policy and let me take the term, level term. So we did a 30-year level term at that time. You could still get 30-year. You can't really get it today. So what I'm showing him here, this is really important you understand this y-axis. This is what you get if you die. All right. So make sure I didn't label the axes, so you got to label them. All right. So make sure you have that in your notes. Some of you aren't taking notes, so I guess you have perfect memories, but make sure you have this in your notes because it will be on the exam. So we have a 30-year term and we have a whole life for $250,000. So the whole life is very simple. If you die with the whole life, you get $250,000. Real simple. No issue there. Just a blue line on 250. All right. So let's talk about the 30-year term. So how do you explain this? So first of all, if you die right when you buy, you get $250,000. That doesn't change. So why is this line going up? Anybody want to guess on that? If you die right here, what are you getting? So it's 30 years. You bought it at 25. So at 50 years old, what do you get? What does the life insurance pay you? It pays you $250,000, right? So what's the higher level? You did what? This premium for the 30-year term is lower than the whole life. You took that difference and you invested it at 3%. So you have $250,000 in life insurance and you have an extra $50,000, $60,000 in that investment at 3%. Everybody see how that works? So if you die here, you get the life insurance and you get that investment. I'm ignoring taxes. So, ignore taxes on this. If you die at 54, you get $250,000 plus an extra $70,000. What happens if you die at 60? Why does it line drop so far? Yeah, the life insurance is gone. What do you have now? Just the portfolio. But you're investing more now, aren't you? If the level term was $50 and the whole life was 300, here you're investing $250 a month, but here you're investing $300 a month because you're not paying any of the premium. All right. What does this look like? Well, right here, this might be pretty close to your human capital, right? Because you've been working all these years. So it may drop down anyway. At some point around 78, 80, your investment, if you invested a difference, actually catches up and you end up with more money than if you had bought a whole life policy. So if you invest a difference, even at a low rate of 3%, you can still come out ahead. Now you might say, well, doesn't the whole life have a cash value? That's true, but remember with whole life, if you cancel the policy, you get the cash value, but if you die, what do you get? You get $250. The life insurance company is essentially paying part of your claim with your money. That's one reason why whole life is much safer to sell than term. With term, they don't have any of your money. If you die, they got to pay the entire $250. But with whole life, they get to pay you with their money and with your money. So it's a lower risk policy. All right, can everybody understand this, that you can explain it? That's with the 3%. Even with 3%, you come out ahead. And if your life expectancy is 80, then you're expected to come out ahead unless you die in this period here, but it may not be a big deal. Here, if you die, you only get $100,000 versus 250, but you're going to retire in a few years anyway. Your human capital's not all that great. Your kids are probably in college or out of college. I don't know, 55. Yeah, your kids are like 30 years old, right? So your kids are out of college. They're on their own. So what happens with this equation is if we change our investment rate, make 6%, here you're slightly worse off, but if you know you make 6%, you might as well just buy the term and invest the difference because you're almost always going to be better off. Now, 6% is a hard return to make over the long term. That's got to be stocks and bonds together. So it's going to be lumpier and bumpier than what I'm showing with the orange line. But at the very end, if you make it to 99, you'll have $2.5 million versus the 250. So your family's probably hoping you invested a difference. Of course, if you retire, you have to start spending some of this, but you have more to spend here than you would with the whole life. The whole life, the cash value, essentially, when you make it to 100, the cash value is essentially going to be $250,000. That's the way the product is designed. If you go to the very, very end, essentially, the insurance company is paying you your cash value when you die. That's why a lot of insurance companies, if you make it to 103, they pay you the 250 when you hit 100 because you essentially earned it anyway. They were assuming you're going to die at 100. You made it to 100. Hey, here's your money. We invested it. It's all yours. So if you can make 6%, yeah, you're much better off just buying the term, investing the difference. That's a tough investment, but it's possible. And then here's the break even, 858. You can make 858. You're never worse off buying a term and investing this difference because that's a high return. The insurance company is just buying high quality or triple B bonds. They're making 5%, and they're subtracting a pretty hefty expense ratio. You do have an advantage over the life insurance company because they do subtract 100, 200 basis points from what they're making. You get to keep all of that if you invest. So you'll probably make a higher return because you don't have to pay all those investment people and actuaries. All right. So what I recommend you do on the exam is maybe pick two of these and talk about them and make sure you explain them fully. Everything's labeled. Students lose a lot of points by not explaining this clearly enough. So make sure you fully explain why the chart is doing what it is. How much different does it look with a 20-year term? Obviously, you're going to have more money to invest because 20-year term is going to be cheaper, but you're going to run out of insurance much faster. But I didn't talk about this in the previous class, but this is an important concept. So with level term, always shop, say 5 years into it. Very important level term. Insurance premiums have been coming down on term pretty dramatically. I don't know, the last few years, maybe not because of some of the COVID issues and some of the drug issues, but over the long term, rates have been coming down. So it's possible, let's say if your premium is $50 a month for 10-year term, in 5 years, that premium might be $45 a month. And if you do that in 5 years, you're going to get 10 years. You're extending 5 more years with a lower premium. You're always going to do that. So you always, when you get a few years in and you're still healthy, now if you're not healthy, it's not going to work. You got to stick with what you have because you won't be able to get the new policy. But if you're healthy, you always switch, add those extra 5 years, reduce your premium. And this is what's been happening in the last 20 years is people are going 5 years into a level term and discovering they can extend it another 5 years and save on the premium or the same premium. Even if it's the same premium, $50, you do it because you get those extra 5 years. You always do that. You do not wait to year 10. You don't do that for a couple of reasons. First of all, the insurance company knows the only people who wait to the very end are the sickest people, and that's one of the reasons the premium is as high as it is. But secondly, you could get really sick in that 10th year, and then you can't roll it over. If you get diagnosed with something in year 10, month 11, you have to fill out the application, let them know you have that diagnosis. They're not going to sell you the level term. So if you're healthy 5 years later, always reshop it with multiple companies as well. And then you just cancel the policy. You stop paying the premium, you lose the insurance, but you got insurance with another company. And so even with these graphs, it could be much better than this because you might be able to extend this continuously until at least until you're about 60 or so. Right. So this is the exam question students struggle the most with. Since we just talked about it, I'd start structuring your answer this weekend just so you can get it fresh off your mind. Start thinking about it. It's a tough question because I didn't write it for you. I just gave you the inputs and you got to kind of restructure them somewhat. Any comments, questions? Anyone here related to Primerica? Parents that sell for it? Yeah, only one I know. Well, so my high school government teacher, he was weird. I don't think he's probably still not alive. We're in this small room, smaller than this, and he always wore a microphone with speakers, like he was a college professor. It was like, we can hear you fine, but he was kind of a weird guy. We talked nothing about government, so I didn't learn anything about government. But he was a Primerica salesperson, and boy, he was aggressive. And then my brother called me once, and he was being sold by Primerica. And I was shocked what they said. I wish I had recorded it and then send it to the Texas Insurance Commissioner, because they said some things. One thing they said was small cap stocks are less risky than bank CDs. It's one of the things they said. What were they saying? Well, if you invest for 30, 40 years, you'll have more money, but we can't talk about risk in that context in finance. Obviously, small cap stocks are much more volatile than bank CDs, but that's not what they said. So it was interesting. He also said, look at our capital ratio. It's better than State Farm. You remember my brother had a level term from State Farm, and they're saying, hey, our capital ratio is better than State Farm's. What's wrong with that argument? They had a much lower rating than State Farm. I think State Farm was AA and they were like triple B. Well, why is that? Well, because their capital ratio is higher because they sell term insurance. It's a much more dangerous insurance. State Farm sells a lot of whole life. They don't need as much capital. If your insureds are helping you insure themselves, you don't need as much capital. So why was their capital ratio better? Because it had to be, because they're a riskier company. And I was real tempted because I had a friend working for S&P at the time. I was really tempted to, because they actually had it printed on a piece of paper. I was going to email it to her and say, hey, you know, one of the firms you're rating is advertising your capital ratio without telling them what their credit rating is from your company. I just want you to know they're using you to advertise them, even though you think they're worse than the competition. But I didn't do that. But I was kind of shocked at what they said. There's a lot of things I don't think are necessarily legal. They could probably get in trouble, but I didn't. They were friends of my brother, and I don't want to like get them in trouble with my, but. So level terms, the play to go if I were your age. Shop at least 5 different companies. I would probably look at 10 versus 20 and see how much. 20s can be more expensive, but if it's only an extra $10 a month, I think I would go with the 20. But then 5 years later, reshop it, look at it again. 10 years later, look at it again. So always within 5 years, go out and price it again. Very, very important. You have no loyalty to these insurance companies. If you cancel the policy, that's their problem. You just cancel it. It's a great insurance. It is very, very inexpensive. It's amazing how much you can get. If you're young and healthy, amazing how much you can get, because your probability of dying next 20 years is very, very, very low. So they're going to be making very few payouts. And so it's great insurance. It's one of the things the insurance industry does very, very well. They're very competitive. They're going to be charging a rate that makes sense. They're not going to grossly overcharge you. It's what the insurance industry should be doing. Not all this other stuff they're doing. All right. Final questions or comments on that? All right. So where do we go from here? So I'm going to do this problem because this is the one big math problem on the first exam. Everybody should get 100 on it, but there's always a few students that somehow get confused on the exam. So I want to talk about annuities, but I want to jump to a particular annuity so we can talk about the math. I'll do a little introduction here, but we're going to jump to it pretty quickly. So an annuity, banks and investment companies have IRAs, individual retirement accounts. They can sell those type of accounts, but they cannot sell anything that's life contingent. They can't sell you something that pays out depending on how long you live. Only the life insurance industry can do that, and Social Security. But it's real confusing on annuities because there's the accumulation period and there's a payout period. Most life insurance companies, when talking about annuity, they're talking about the accumulation period, which is nothing more than an investment. You don't need a life insurance company to do the accumulation period. You're just saving money. The life insurance company is the payout portion. So banks and investment companies can give you accumulation products where you're just investing month after month and seeing what you have. So the advantage life insurance companies have on the accumulation period is the taxes. So a Roth IRA, I don't know what the current restriction is. Let's see. Yeah, contribution limit. So is that single?
Yeah.
So for a couple, it's, and then there's a catch-up one that old people like me can do. 6,500. So you kind of stop there. And if you have a 401k, you may be limited as well. That's not a lot of money. With life insurance, you can do this same IRA with them with the 6,500, but with life insurance, you can do a lot more. It's not tax deductible or it's not tax free, but it's tax deferred for a very, very long period of time. And that's incredibly valuable. So that's an advantage life insurance has that other entities don't have, is that you get that incredible tax deferral. The Roth is pretty limited. Y'all know the difference between Roth and traditional, right? Roth, no tax deduction, but tax-free forever, which is a wonderful thing. Traditional is you get a tax deduction today, but you have to pay tax when you take it out. With life insurance, you get the tax deduction for a traditional part. The rest isn't tax deductible, but tax deferred. If you're talking 10, 20, 30 years, tax deferral is a huge, huge, huge number. You do have to be careful that if you change your mind and take the money out early, those penalty taxes can be quite dramatic. So, so we're going to talk about the accumulation period, and then later we'll talk about the payout period. So what I want to do is talk. Oh, there's that chart I was looking for. This chart will work. I'm on page 27 of the notes. This chart will work in your paper 1. Y'all see that? Defined contribution, defined benefit. Remember in the article from David Babel, he was talking about that. So I that's why I couldn't find it. I have it on the wrong page. But I mean, I should have copied it in 2 places. So page 27 is a really good chart. You can really see the growth in 401k plans, just really, really dramatic. So what I want to talk about is a special type of accumulation annuity, which is called an equity-linked annuity. Any of y'all, if any of y'all related to this, I just warn you, I'm about to dump on this product. I hate this product. It's intense. This is the product I told USA I'm quitting if we ever sell this product, because I just think their argument was, yeah, it's a horrible product. Ours will be better than everybody else's. It'll still be horrible, but it won't be as compensatory as our competitors. And I was like, yeah, we're going to sell a bad product that's not as bad as everybody else's. That doesn't sound like USA to me. We're owned by our customers. We should only sell good products. So if you go out on our site on Canvas, I've added these 2 things here. Equity-linked annuity article highlighted. And then a math, this is the math example that we're going to do for exam 1. All right. I'm going to load this article, and it's highlighted, so you don't necessarily have to read every single word. It's an old article, but there's nothing in this article that is untrue, and I just can't find an updated version of it. So it's out there for several years, but it's still very, very, very applicable. It says an overview. They should say a dismantling of equity-linked annuities. So 2 PhDs. Why? Because only people with PhDs can understand this product. So let's walk through it. This is equity-linked annuity. This is the product a friend of mine had bought, and I was shocked he bought it. And I just had to bite my tongue. I said, yeah, that's a complicated product. His was actually an equity-linked universal life policy, which is even worse. It was based on 2 indices, not 1. It was just like, they said, you know, this is really complicated, but I think I can make it more complicated. And that's what they sold him. It was just ridiculous. He didn't understand it. He thought it was an annuity. Like, no, that's not an annuity. You have a universal life policy. I mean, Like he didn't even really know what product it was. But it was really scary. Hopefully they never watched this video because I was too scared because he gave them a lot of money all at once. All right. So at the time this article is written, these were very popular products. They do well anytime the stock market's doing well. And the argument is a lot of them were advertised. You get all the upside of the stock market, but protection on the downside. So you can't lose money on the downside, but you can make all this upside. Does that sound too good to be true? Sounds way too good to be true. So the formulas are so complicated. It's regulated by the states. There was a big push at the time of this article. There was a big push to make these regulated by the federal government, but they lost, the federal government lost that argument. So they are not regulated by the federal government. So this isn't like variable products where you have to have both state and federal. These are just state-only products. We estimate that between 15 to 20% of the premiums paid is a transfer of wealth from unsophisticated investors to insurance companies and their sales force. So they just think it's a rip-off product that's just doing nothing but producing fees for the insurance industry. So that's their introduction, our pre-introduction. So how did it get away from this product being insurance and not an investment? Well, with a lot of these annuities, including variable annuities, they have a little bit of life insurance in there. So they can say, hey, this really is life insurance. They're very trivial. They're very small, although we might talk about Hartford Life and the big blow up they had in 2008. So it can come back and haunt the insurance industry. They add trivial insurance benefits, bad tax treatment, high costs, and sell them as variable annuities. So that's the variable annuity. So they're saying it's the same type of thing with equity index annuities, trivial insurance benefits, bad tax treatment, high cost, and sell them as equity index annuities. The difference between these two is variable annuities are actually not on the books of the life insurance company. When we look at accounting, you're going to see that they have to put it off in a completely separate company. Equity index annuities are actually on the books of the insurance company. So they have to somehow invest your money in a way that you get the upside of the stock market, but you don't lose money on the downside. So repackaging these as equity index annuities has exempted them from securities regulation. It was really close. I think the SEC was really close getting these things regulated. NASD was like, we hate these products because we think the insurance industry is stealing from our customers, and so they wanted them regulated, but the insurance industry had some powerful lobbyists. So this gets back to the comparison shopping. Investors in equity-linked annuities cannot determine the cost they are incurring. Why? Because the formulas are so complicated. Complexity makes it virtually impossible, even for the people who know what they're doing, brokers and agents, to evaluate these annuities. That's not a good product, right? So if you read my blog on this industry, what I always recommend with a product like this is you always say, I need to see the last 30 years of exactly how this product would have performed, precisely how it would perform. I want it in 5-year increments, and I want to compare it to just an index stock mutual fund. They won't give that to you. Why? Because they can't produce it. It's too complicated. The actuaries at the firm probably can produce it, but the sales rep can't produce it. But that's, you always ask. If they say we can't do that, it's like, okay, if you can't show me how this is done historically, what product do you buy on the investment side? They can't tell you how it's done in the past. That doesn't exist unless it's this particular product. So these salesmen, people can't figure it out. What can they figure out? They can determine their commissions. Their commission's 10% of the premium. You walk in with $1 million, they know what they're getting. You're getting 100,000 bucks. That's pretty good. And as I said again and again, you should always know what the commission is on a life insurance agent, because if they're charging a 5-10% commission, there's no way the product's any good. There's nothing in a life insurance. I mean, that's true, right? It's pretty obvious. There's nothing a life insurance company can do to your benefit if they're taking 10% off the top. There's no way you can catch up with any other product. The tax advantages, maybe, but that's going to take you 20, 30 years to offset that high commission up front. So it's not like insurance companies have this magic. They can pay a 10% commission and still invest your $100,000. It's just not going to happen. So they start off, if you give them $1 million, they're starting off with 900,000. 100,000 just went to the sales rep. You already have a 10% loss from day one. It's an impossible product. Much higher commission than you see on any type of other product. Misleading marketing claims. A lot of it is upside without the downside. This sounds really, really wonderful. Any recommendation to liquidate the securities to purchase an equity-linked annuity requires a determination that is suitable. Now, y'all know the difference between suitable. That's got to be right. Fiduciary, oh, fiduciary, right? No, that's better. Which of these standards would you rather have from a life insurance salesperson? Fiduciary. What does fiduciary mean?
They have to look out for your
Client's best interest. What is suitability? Suitability means you can make an argument that someone in the world could conceivably buy this product. Not the product you're selling, but a product like you're selling. So you could buy selling a product that's horribly designed, grossly overpriced. But if a product like that could be sold to a person like this, it's suitable. Not your particular product, but that type of product. So your product might have massive expenses and all these kind of horrible things, not suitable for anybody. But another company with a product like that without those horrible fees, if that could be suitable, you can still make the suitability argument. It's extremely weak. Guess what the insurance industry was arguing for? They wanted a suitability standard, not the fiduciary standards. So life insurance companies don't like to have to put their client's best interest first because a lot of their products don't really work well in that context. They applies the principle broker-dealers will no longer be allowed to sell. So NASD doesn't like these products. They say they're too complicated for their client, their salespeople, too complicated for the sellers, too complicated for the buyers. Allows insurance companies to sell investments which are much more costly and much less liquid than available alternative investments. Now, let me just say up front, I love this type of product. So I like a product that upside with limited downside. It's a great, great product. What does that look like? Well, you buy the S&P 500 index fund and offset with put options. We're going to be talking about put options. If you don't remember put options, essentially what is that? You buy the put options, that's like buying insurance. It's going to reduce your return. So if the S&P is up 10%, maybe only make 8%. But if the S&P falls 40%, your max loss is maybe 10%. I like this type of product. We'll talk about it. I'm going to show you the actual math. So you can create the equity-linked annuity yourself without the life insurance company. You can create it yourself without the life insurance company. And I'm going to show you. We're going to do the math. We're going to actually create it like this so you can see the actual math. I think it's a wonderful product. But you don't have to pay all these fees to the life insurance company to get it. You can do it yourself. You could do it yourself in a Roth IRA or whatever. You can do it yourself and not have to worry about the tax implications. So I'm not saying I hate the concept of this type of risk management. I just hate the fact that it's so expensive from a life insurance company. So life insurers are fighting back. They say they're not securities. We don't want the SEC regulating us. And I love this comment. Some of these products are suitable for seniors, and not all of them are horrible products. There's at least one of them out there that's decent. So we should be allowed to sell these things. So that's a really great argument for your industry, isn't it? I know there's one guy named Joe who's selling a decent one in New York. Right. Now this next sentence, you got to just understand this and the way the product is set up. So equity annuities, they don't guarantee you won't lose money, but they do guarantee you a minimum return. So what in the world does that mean? Well, if you got a 10-year policy and the worst you can make is 3% over those 10 years, that sounds like you can't lose money. But what if you're up 12% after the first year? And they only have to pay you 3%. What can happen the second year? You can lose enough as long as you're still in that 3%. That sounds like a loss, doesn't it? If you made 12 and now you're back down to where you started. So essentially what they're saying is you can't lose money. You can't lose more. I mean, you have to make at least 3% over the 10 years, but it can still be a bumpy ride on the way because you might make some years and lose others. So you can lose money in any given year. The guarantee is usually pretty low. I'm going to show you mathematically why that's the case. You can't guarantee some on the upside and a minimum downside unless you have some way of making up that difference. Also, the guarantee return doesn't apply to your entire investment. And some, they do it without compounding. And some of them, they say, yeah, we'll guarantee you a 3% return, but you got to hold it all the way to maturity. If we mess up, do something that angers you, our company's going insolvent, if you get out of this thing, we don't have to pay anything but what you actually earn on the policy. Where do you find all this stuff? In the 10 pages of footnotes, right? It's a very complicated product. Who's going to read all that stuff? All right, so you do have an index. That's why it's called index. Usually the S&P 500, though the guy I was looking at he had S&P 500 and the Dow, which is just so bizarre. Why they put those two in there, I don't know what they thought they were going to say. Hey, we'll put the Dow in there. We'll pick up more customers. That just is strange. Sir made the policy a lot more complicated. The indices are price only. That's really important. These are not total return. These are price only. So dividends are not included. That's a huge part. You might not think that's a big part of stock returns, but it's a huge part of stock returns. The exclusion of dividends causes the change to SP index to be significantly understate the returns, as dividends have accounted for 20% of returns of the stock market. You may say, well, 20%, but we're talking about compounding year after year. You're making 20, instead of 10% making 8, and you compound that over 10 years, the ending value is much, much, much smaller. Right? So there's one big red flag. All right, so the participation rate, this is the craziest part of all. When the guy showed me his policy, I was going to try to get into it, and I was like, that's going to give me a headache. So the participation. So this is supposedly the percentage of the index return you get credited. And let's say we have two companies. Company A, they have 100% participation. Company B, 50%. Which would you rather have? 100 sounds pretty good. However, it's quite possible that the 50% is going to give you a higher return than the 100%. How in the world is that possible? Well, I'll show you. It's in the complexity of how that 100% is actually applied. But guess what the sales rep wants to be able to say? 100%, right? That sounds really, really good. We give you 100% participation. You're thinking, wow, if the S&P is up 200% over the next 10 years, I'm going to make that full 200%. You think that's possible? Absolutely not. Well, first, you're going to lose all the dividends, but even after that, you won't get 100%. So the participation rate is the fraction of the change in index credited to the investor. They vary significantly and can be applied to different measures of index level changes. Participation rates are easy to compare, right? 100% versus 50, that's easy, but are misleading. Higher participation rate may not mean higher payouts to investors, since equity annuities are not all else is equal. That seems, you think their state regulators would say, hey, you all got to use the same method for calculating it. You can't have one salesperson saying 100, another saying 50 when the 50 is better than the 100. That can't be. All right, there's 3 common formulas. There's point to point. The point to point measure measures the increase in index from the beginning to the end of the contract term. In some contracts, a point-to-point return is calculated at regular intervals, usually at the contract's anniversary date, and index is reset to ratchet up to reflect the credit return. So that's, January 1st through December 31st. How much did the index change? There's also the monthly average return method. It calculates it from the start of the year to the end of the year using monthly averages. See if I can do this in time. We'll try. Does that make a difference? Let's say the index starts the year at 1,000, ends the year at 1120. So it's up how much? 12%. So December, it's 1,000. And then it rises $10 every month. Just make it real straightforward. So let's say you have 50% participation. So you say, okay, 1120 divided by 1,000 minus 1. So it's up 12%. So my return is 12% times 0.5. I got 6%. That's pretty good. Now let's do, so this is the point to point. The other company has 100%, but they do monthly average. So they average this divided by that minus 1. That times 100%. So which was the better participation rate? They're the same. One used the monthly average, one used the point to point. The monthly average, if the stock market's generally going up, the monthly average is going to give you a much lower number. Or if the market's up 10, the monthly average is essentially going to give you 5. So you can see the 100% and the 50% participation, it all depends on what your calculation of the index is. So other things equal, equity annuities with resets are more valuable than annuities without resets, and point-to-point annuities are more valuable than monthly averaging annuities. How many of the people buying these products understand anything in that sentence? Probably almost none of them. The sales rep says what? 100% participation. And did they then say, well, let me explain to you because we have different methods? No, they're going to say, hey, 100% participation. Client, you can interpret that however you want to. We didn't lie to you. It is true. Insurance companies can offer higher participate rates on annuities with monthly averaging because monthly averaging systematically understates the increase in the level. The expected index change with monthly averaging will be roughly half the expected change calculated for traditional point to point. Thus, under the monthly averaging, it can claim 100% participation while only paying 50%. Pretty smart, right? These people are pretty crafty people. Then they start showing us some charts. Here's the S&P 500 with reinvested dividends, starting with $100 over, what is that, 30 years? $100 to almost $5,000. If you take the dividends out, does it have an impact? Is there a big difference between 4,900 and 1,800? And then when you do monthly averaging, does that look like 100% participation? What do you think about a product that says we have 100% participation and you get 544 instead of 41? If you had just bought the S&P, you'd have 49.21. This product, you get 544. Does that sound like honest advertising? Sounds like a scam, doesn't it? So, all right, I'm going to start here. Y'all can see why I hate this product so much. If any of y'all sell this product and want to defend it, have at it. Next class, set up a time, we'll debate it. But I'll start here next time. Any questions on anything? How's your paper one going? Doing all right? You want to meet with me on it, Zoom or whatever? If you never had me before, I highly recommend you at least touch base to make sure you're not way off base, because I'm real picky on papers. I like substance and depth and detail, so make sure. All right, let's go there. Make sure you have this product that says that they're giving you the stock market return, but we just discovered there's three issues or two issues there. One is for excluding dividends, which has a huge impact. And what exactly do we mean by the market being up or down? Is it an average? Is it point to point? Point to point is going to give you the best answer. Averaging over time, it's possible average could do better than point to point. The market's up a bunch and then falls at the end, but over the long term, averaging is going to essentially reduce your return in half. So they did it at a shorter period of time, just over 10 years. In 10 years, it's just dramatic. Not having dividends brings the return down quite significantly, and then using the monthly average brings it down some more. So it looks like a pretty bad product if that's where they stop, but that's not where they stop. It gets worse. So if you look at the next section, the gross credit calculated by multiplying index change by participation rate is then sometimes further reduced by a spread. Can be as great as 3%. That's pretty significant. Two contracts linked to the same index with the same indexing method and same participation rate can be off because of this spread. So they might say, well, give you the S&P 500, 100% of it minus a 3% spread. That's going to be pretty significant. And then also on top of that, they may do caps. Say, hey, if the S&P is up more than 20%, we're going to cap it at 20 or at 10. That can be huge, because you look at the historical average of S&P, it doesn't make 7% and 9%, 8% and 10 and 12. It makes 35 minus 20, 30, 20. It's the big numbers are important. So the effect of caps is dramatic because the average long-term return to stocks is heavily influenced by those high years. The annualized price appreciation from 75 to 2004 was 10%. If we cap it at 14, it drops down to 5.5%. because you're missing those 25, 30. Think about a year like 2008, you lost a lot. Well, the next year the market's up 70%. When the market falls 35%, you need that 75%. You get that 70% just to get you back to where you were. If you cap it at 15, 20%, you're missing those big swing back years, which are huge, huge to your return. So are these good returns? If you want some market return without market risk. And so what they say is, why don't we just compare it to a simple strategy? This is a complex strategy. Let's take a simple strategy. What if we just invested in stocks and treasury securities? That's pretty simple. So we put $60,000 in 10-year treasuries and $40,000 in S&P 500. That sounds pretty low risk, doesn't it? Is it low risk as the equity-linked annuity? Well, look. And so here's what they found. 96.9% of the time, they did better with the treasuries and the stocks than with the equity-linked annuity. So it doesn't always win. It wins 3.1% of the time. But 96.9% of the time, you're better off. So then the question is, well, how does it do in that 3.1%? Maybe it's kind of almost as good 96.9% of the time, but 3.1 is fantastically better. Not quite. So we'll talk about this in a second. But after 10 years, the expected value of treasuries and stocks was $219,000. The equity-linked annuity was $186,000. Fairly significant difference. How do you break up this difference? When the annuity is not doing well, that's 33%, $33,000 difference. When it does better, it's a $219 difference. So when the annuity does better, it just barely does better. Not significantly better, just barely does better. Even this comparison, I mean, it's like, can you just stop now? It's like, okay, let's throw another wrench into this. It's overly generous because we have assumed that the contracts were held to maturity, so no surrender charge applied. But insurance companies hate it when you surrender their policies. The IRS also hates that. And so try to get out these things early, you're usually going to pay a huge penalty. So the tax treatment, the returns earned on equity annuities are taxed at your marginal income tax. If you buy stocks, those gains often are capital gains, and they're taxed at a capital tax rate, which is usually much lower. Back here is much, much different. It's not as big today, but back then, capital gains were taxed at 15%, where your income was taxed at 35%. That's a pretty significant difference in tax. You really want it to be taxed as a capital gain, but another big difference. There is an interesting fee and expense twist. Equity annuities do not have explicit annual fees. Instead, the insurance companies makes money by giving the investors less than what the market actually earn. The insurance company takes the dividends plus 50% of the capital appreciation. So what do you think their conclusion is? Therefore, we recommend you place a significant portion of your portfolio on equity annuities. Is that what you're expecting at the end of this? Equity annuities are complicated investments sold to unsophisticated investors without the regulatory safeguards, right? Because remember, the SEC is not regulating these. No registered rep, insurance broker, or retail investor, or precious few PhDs could understand these products. The net result of their complex formulas, hidden costs, is that they survive as the most confiscatory investments sold to retail investors. They think not only is it bad, they think it's at the bottom of the list. And I agree with them. I think this is I start off with the huge commission, which I already told you, that already tells you it can't possibly be good. Then the complication, I don't think we should be selling products this complicated to the general public. It doesn't make sense. And then just the fact that, the statistics show that it's just not a good product. Now, what is all this stuff up here? This is what I mean by the term stochastic dominance. So when you see the word stochastic, you're thinking simulations, Monte Carlo. Y'all done some Monte Carlos. So you'll have to take a stochastic class, don't you, in actuarial science? Or is it an option?
But it's not required.
Not required. Y'all taking it?
Not yet.
Not yet. I mean, on the life side, pretty important. They do a lot of on the PNC side, they do a lot of simulations. It's pretty common. The nice thing about stochastic type of models versus just a Monte Carlo is it's a lot more sophisticated. You got a lot of correlations, you got a lot of distributions, you can manage it a lot better. It's not just going in Excel and running some Monte Carlo, with random numbers. So what stochastic dominance means is if you run a million scenarios, this strategy wins, but it wins so infrequently, and when it does, it's so barely above that the other strategy just dominates the stochastics. So it's not like it's 100% loser, but it's a 96.9. So the simple strategy dominates this complicated strategy. So how do you sell the complicated strategy? You make it so complicated, no one understands it, and you offer really large commissions. That's how you get it to work. You understand the term stochastic dominance? Now, could you pull any of this into your ethics question for exam 1? Yeah, you probably could. So remember in the ethics question, what was one of the lines? Complexity, overly complex products. You could say, for example, as we just discussed in class, and you could pull some stuff from this article for your answer just to demonstrate the complexity of it. These things were selling very popular products when the stock market was so strong, especially in the 90s. So they were selling them. No doubt this was a popular product. Don't you wish I had some videos of the sales pitches being made for these things? And the SEC, we'll talk about the SEC. Their biggest concern was how these things were being marketed. That's one thing the SEC looks at and says, okay, it's insurance. It has aspects of insurance to it. But if the marketing's 100% as an investment, then this isn't insurance. This is an investment. If you're selling it as an investment, don't tell me it's an insurance product. Just by putting some really minor things in on top of it. All right, so let's look at this thing. So if you want to get this off of Canvas, there's a file out there under miscellaneous class files. It's called Equilinked Example. So I'm going to work this one tonight, and then I'll work another one next class as well, so you get some practice. And then there's this one actually has a YouTube, so you can watch the YouTube as well. One thing wonderful about interest rates being higher, you're going to see, is it makes this strategy far more powerful. So if you have this file open, you'll see that's what it looks like at the top. Are y'all seeing that? Some of y'all are in Canvas. Some of you are doing what I recommended last night, right? Take notes by hand, which is good. All right, so I hate the product, but I love the strategy. How can that be possible? Well, because the strategy is designed to make the insurance company and the agent money, not the investor, but you could actually create this yourself. It's a little touchy. I'm going to use some artificial things in here just to make the problem simpler, but this is not a difficult thing to set up. So let me just start with this particular idea. You have $200,000 to invest. The risk-free asset is offering, say, I don't know what I use here. Let's say 5%. And you need a guaranteed 2% return. All right. For you to live throughout your retirement, you need your portfolio to make 2%. So let me show you this strategy. You invest 5% to get the risk-free enough to guarantee 2%. So how many years? Let me use the same number of years. 8 years. Let's use 10 years. All right. Over the next 10 years, you want to make sure you make at least 2%. Maybe you think that's what inflation is or whatever. I need to make at least 2%. All right. So what do you need at the end of 5 years, 10 years? You need 200,000. Y'all remember your future value formulas? What's the rest of it? Does that look right? Right. We did this. Remember Cassandra and Humberto? We did those. And forget who else was in there. Gilbert. We did those cat bonds. Similar kind of thing. Very similar type of thing. Not exactly the same as this, but similar type of concept. So if you do that, $200,000 times 1 plus 2% for 10 years. At the end of 10 years, you need this portfolio to be worth $243,000. If you do that, you got your 2% return locked in. Now, one thing I do warn you is I'm doing this in Excel. On the exam, you won't have Excel. So make sure you reintroduce yourself with your calculator, that you know how to push the buttons on the calculator. I don't use calculators ever. It's always, I think there's like too many buttons to push. They like, can I just hit equal and give me the answer? No, you have to do this calc and then this. So make sure you remember how to do that. But we don't need to invest $200,000 a day, do we? So that's the ending value at 2%. But what can we invest risk-free today? $5%. So how much do we need today if we can make 5% so that we end up with 243,000? So here we just did 200,000 times 1 plus 0.02 raised to the 10th. Well, here what we're going to do, we're going to take 243, 798, 88, and we're going to divide by 1 plus 0.05 raised to the 10th. Why? Because we don't know how much of that risk-free bond that we need if we invest at 5% to give us that 243,000. So we don't need to invest $200,000, do we? If we invest $149,000 at 5%, at the end of 10 years, we'll have $243,000. Everybody see that? So how much money do you have left over today? This is the big mistake on the exam. Let's see if we can prevent y'all from doing that. You had how much money to invest? $200,000. How much have you invested? 149,000. How much do you have left? This is what students do in the exam. I've got $94,000 left. Is that right? You don't have 94,000. How much do you have? 200,000 minus that, so you got 50,000 left. So this is your play money. Y'all see this strategy is a powerful strategy. What this is telling you is invest $149,000, you got 2% guaranteed. You got $50,000, you can do with that whatever you want to. You can go to Vegas. What if you invest the 149,000 at 5%, you take the 50,000, go to Vegas and lose it all at Vegas? What will your return over the next 10 years? 2%. All right. So the question is, what can you do with this 50,000 to enhance your returns? And it's anything you want to do. We're going to put our play money in options. Why? Because we want something that if we lose money, the most we can lose is 50,000, right? We can't have something that can make us lose 70,000 because then we could lose our 2%. We want something, the worst we can lose is $50,000, but we want a lot of upside. And that's what options do. We can't just stick it in the stock market because they only have 50,000 in the stock market. We put it in the option market, the market goes up, we're going to get a big return because we have options. Okay. I love this strategy. I recommend this strategy actually for senior citizens and other. I mean, it's just a really, really good strategy. You know for a fact you're going to make 2%. And all you got to do is figure out now what you do with that 50,000. You better think about it because you don't want to waste it. But you have that potentiality there. So that's what these things are all about. The insurance company is not creating magic. They're simply using this formula. That's how they're getting you your guaranteed return. It's not guaranteed every year. It's guaranteed over the 10 years. So you might go up 10, go down 7, whatever. You can still gain and lose money. But at the end of the 10 years, you should have at least 3%. Why? Because, or 2%, because that's how they set up the product. They bought enough. Now, the insurance company is actually taking risk. We'll get into this later in class. They're not buying treasuries. They're probably buying corporates. That's something life insurance companies do. They do bet the farm on credit. And that's their risk. That's one of the reasons the SEC has let them go unregulated by the SEC is that say, well, at least the insurance company is taking some risk. If these bonds default, that's the insurance company's fault, not the investors. So we'll talk more about that later in the class. But that's the equation. That's how it's set up. So let's do the problem. Now we see that one formula. That's really the key to this whole thing. All right, questions up to there. Y'all know how to do the math. You'll have this on Zoom, so you can snip it on Zoom if you need a picture of that. So I probably should just do this. So the math question for exam 1 will look exactly like this, but with different numbers. So let's look through this. So there's our annuity premium. The person walks in and gives us $200,000, but we're going to do this ourselves without the life insurance company. So what's the sales commission? It's zero. That's kind of nice. That gives us an extra 10,000, 20,000 just to start off with. So we're already 20,000 ahead of the life insurance company. We want to make at least 1.5%. That's their minimum crediting rate. By crediting rate, we mean what the insurance company is going to pay you. Be careful on this on the exam, that you use the right number of years. Some students, they get habit of doing the practice of problems and then it's a different year. So I'll try to use different years there. I haven't done this. This is an old problem. So the S&P was at 1450 when I did this. That was a few thousand ago. I'll give you a more recent up-to-date problem. But that's the current level of the S&P at the time I did this problem. All right, we're going to do a call option. So let's talk call option. First of all, an option. What is an option? Security giving you the right to buy. That's called a call option. Or sell. It's a put option. A security at a given price. It's the strike price. So you have the option to do something. You don't have to do it, but if you want to do it, you'll do it. When will you do it? Well, if it makes you money. If it doesn't make you money, you just let the option go down. Have y'all had options in a class sometime? I know some of y'all were in my class last semester. I've seen. Or any of y'all option traders? You know, I did a bunch in 2008. It was a great year. All right. So at the money means the strike equals the current value of the underlying security. So if the S&P is trading at 1450, then the strike is 1450. So it's at the money. You have to do that. You know, insurance companies, there's different ways they can set this up. I'm keeping this really, really simple, but at the money, which means I don't tell you the strike. You just know it from the context of the problem. So the price of an at the money call option. So what's the strike? The strike is whatever the S&P is because it's at the money. So the strike is 1450 and the S&P is at 1450. All right. So that's just, don't come in an exam and say, well, what's the strike on the option? It's right there. It's because it's at the money. If I said this was out of the money or in the money, then you'd have to ask me what the strike is because then you wouldn't know. But if it's at the money, it's going to be whatever the S&P is. What would out of the money be? In this case, I'd be like 1,000. In money would be like if the S&P is at 2,000. If the strike were 1450 and the S&P was much, much higher. But you don't have to worry about in the money or out of the money. It's just going to be at the money, which means the strike is whatever the S&P is. And then we have an option premium. Now, some of you do options. You know, options trade in 100 in a contract, 100 options in a contract. Ignore that. There's only one option, okay? And we have a 8-year Y0 coupon. I'm just keeping it simple. Because if it pays interest, that creates a whole nother calculation. Zero coupon means it doesn't pay any interest. It's a discount note. You buy it at $500 a day, and it matures at 1,000 or whatever, and that gives you the 4.5% return. So there's the inputs. Here's the first question. Everything in yellow, everything in blue is what you have to do on the exam. All right, the first question is what I just did. How much of this bond do you need to buy so that you guarantee the 1.5%? Okay, we just did that, right? With the 5 and the 2. So now we're going to do it with 4.5 and 1.5. That's the first thing you had to answer. The second thing is, how much money do you have left over? That was our 50,000. So what are we going to do with the 50,000? Well, you only have one choice. You're going to buy options. And each one costs $500. So it's pretty easy to figure out how many options are you going to buy. So that's the second question. And then the last question is to fill in this table. So you have to calculate all of that, and then you're going to calculate all of that. So on the exam, I don't give you the answers, just to make it really clear. We'll work some, we'll actually do the exam question from last year. I'll probably give you a more current one because it's much more exciting. You can see why it's much more exciting when interest rates are higher. When interest rates are higher, I mean, if this were interest rates were 8%, guaranteed 4%, I mean, you can guarantee much higher returns if you have much higher money to invest in. So think about a product like this in the early 80s when 30-year treasuries were paying 18%. Just think what guaranteed income you could put in there, and you could splurge the rest on the stock market. I mean, yeah, we used to have 18% treasuries. You could have guaranteed yourself a 12% return, and you would have had 81,000 left over to do whatever you wanted to with. You don't get many periods like the early 80s, but today at least we have treasuries up above 4% or 4.5%. I think we're getting up to 4.5%. So higher interest rates makes a big difference. All right, so let's work through it. And if you have a calculator, try to do it on your calculator. Actuaries can do it in their head, but finance majors, you'll have to get a calculator out. All right. So exactly what I talked about. Step one, how much do you need? I use the word defease. Bill Gates doesn't think the word defease is a word, but we use it all the time in finance. Defease means to essentially take care of that guarantee, that 1.5%. So there's two steps here. The first step is how much do you need at the end of the 8 years? And then the second step is how much do you need to invest today to get that, all right? So you're guaranteeing them a 1.5% return. They're giving you $200,000 over 8 years. So $200,000 times 1 plus 0.015. You don't have to do that. You can just type 1.015 raised to the 8th. Be careful on the parentheses. We'll see. I don't know how. It doesn't make a difference, but on your calculator, be careful. On Excel, it's the order operand, so it's going to do the raise it a 10th first. What you don't want it to do is that, right? That would make it a problem. So make sure on your calculator that, the problem with the calculator is once you hit a button, it assumes you want to stop there. So make sure you practice it, get the numbers set up correctly. Right. So if you put this in your calculator, 200,000 at 1.5% for 8 years, you should get 225,000. So make sure you're getting that number out to the 52 cents. On the exam, you can stop at 52 cents. I don't need you to go out 20 decimal places. Is anyone getting that number? Yeah. All right. Good. Now, how much of that bond, that 4.5% bond, how much of that do we need today? So we need 225, 298 in 8 years. We can buy a bond making 4.5% today. So now instead of multiplying, instead we're going to divide. And that means we need to invest 158,426.57 today at 4.5% in order to make sure we have $225,000 in 8 years. Now, if you're doing this like for your grandparents or something, you probably can't find a zero coupon, but if you find a bond mutual fund that's yielding 5%, you can do the same math. If it's an intermediate term bond fund, you can probably use 5 years. If it's long term, you can probably use 10 years, but you can do the same thing yourself using mutual funds. It's gonna be a little messier because they're reinvesting dividends, so you have some reinvestment risk, but it's gonna get you essentially the same type of equation. All right, so y'all getting 158,426? Someone gets it, let me know. No one's saying yes, so they have a math error. You got it, Dylan? Okay, all right. So my play money is going to be the 200,000 I started with, and make sure here it's 200,000. So really emphasize in your notes about a fourth, fifth of the class will use 225 here. You don't have 225 today. You only have $200,000 a day. You're going to invest $158,000 a day. All right. So make sure you have that. So you have $41,000 left over to do with whatever you want to do. And this problem only gave you one choice, but in reality, you could do whatever you could buy call option on emerging market stocks if you wanted to. You could buy call options on GameStop stock if you wanted to. You know, there's no limit what you could do. If there's a stock you think is going to skyrocket, you could put a call option all on that one stock. What's the one side of this that's not reality? It's the 8-year maturity on the option. That's something you're gonna have a tough time managing. So you have to manage that. You'll have to manage that judiciously because you have some rollover risk with this particular option. But we're pretending like there is an 8-year option out there. You could probably go out 3 or 4 years, but 8 years is going to be pretty tough. But there are ways to get around that. But I'm just keeping it for the case of the problem, just keep it really, really simple. All right, everybody see the 41,000? So what are we going to do with that $41,000? We're going to buy options, each of which costs $500. So we take our 41,000 play money, divide it by 500, and then you'll get a number. I recommend you just go up to the next number up. Don't round, but just go up. All right. So truncate, but up. I don't know what the actual number is. Maybe it's 82.9 or 82.1, but just go up to the next number, 83. If you don't do that, I don't count off for it, but it's actually a little safe. You'll see why it's a little safer to go up to the 83. Are y'all getting 83 as well? It's a pretty easy calculation to make. All right, questions up to there. It's 3 steps, and you got everything you need. Now, could you do this with futures? What would be the problem with futures? With the futures, you have unlimited gain, and what else do you have? Unlimited loss. Futures won't work. You do futures, you could lose 300,000, 400,000. So futures don't work. Options, it's a one-sided bet. You got the upside, limited downside. Futures, you have upside and downside. So it has to be something that only gives you upside without the downside for it to work, which is what an equity-linked annuity is. All right, you're ready to fill out the table. So let's say 8 years later, maybe the S&P is at 870, so it fell quite a bit. Maybe it's at 1450, so it didn't move at all. Or maybe it went up to 2850. Those are the 3 scenarios. So what is your bond portfolio going to be? Well, you already know that, right? You already calculated that up here. That bond's going to mature at 225, 298, unless it goes insolvent, it goes bankrupt. But the insurance company takes that risk. That's the one big risk insurance companies take. So that one's very straightforward. You just pull it from what you've already calculated. I mean, you can calculate it again if you want to, but it's just going to be 158, 426.57 times 1.045 to the 8th, and that's going to give you 225, 298. So you already know what it is. Everybody understand that number? Why doesn't it move when the stock market goes up and down? Because it's a bond, a risk-free bond, or essentially a high-quality bond. So what's the option worth? All right, so forget how many of y'all took my investment class. Dylan, you're in there, right? Do you remember the gain or loss on an option? I mean, it's sitting right there. Equals the max. So there's 2 formulas. There's one for puts and one for calls. They look very similar. So the underlying minus the strike, comma 0 times number options. The underlying is the S&P 500. So the max, the S&P 500 here is 870. Our strike is 1450, remember, because it's at the money. What's the max of that in zero? 0 times 83 equals 0. Now, could you execute the option? Yeah, you could. Your broker would think you're really weird, but you don't have to. That's not true with the future. With the future, you're going to have that loss. But with an option, if you don't like this difference, you know, what the option is saying, you have the right to buy the S&P for 1450. You can buy for 870. Someone calls you up, hey, I'll give you the option. You can buy the S&P for 1450. And you look and say, well, I can buy it for 870. No, I'll just buy for 870 and say, forget, I'll just let that option expire worthless. How much did you lose? Well, each option is going to cost you $500, so you lost the $500, but that's better than losing more money by executing the option. All right, what if the S&P is at 1450? What's the max of 1450 minus 1450 and 0? It's 0, so it's 0. What if the S&P is 2850? The max at 2850 minus 450. Y'all may double check this one. I get 16,200. So it looks like 400 times 83 or 1400. Yeah, 1400 times 83, 116,200. Dylan, you remember this formula for a put option?
Oh, for the put.
Yeah, you just strike. It's strike minus underline. For a put option, it's strike minus underline because you have the right to sell it at the strike. But we're only doing call options here. Could you set this up using puts? Yeah, it's actually, there's a way to do that as well, but it's a little bit more complicated. Is everybody getting 116,200? Does that look right? So what's your equity-linked annuity? Well, you just add across. It's the value of the bond portfolio plus the options. So if the market doesn't move or if it falls, you get that guaranteed 1.5%. That's yours to keep. If the market goes up, you get your bond plus you get the call option, which gives you 341, 498.52. Okay. And then what is your return? Your return is your ending portfolio divided by your beginning portfolio. What is our beginning portfolio? With $200,000. That's what we started with. Raise the 1/8 because it's 8 years minus 1. Now there's the option. We usually write it as S minus X or S minus, what's the other one? Sometimes it's X, sometimes it's K. It depends if you play baseball or go bowling. So the strike, I usually see it as an X, but I have seen it as a K. So it all depends on what sport. So the stock price minus the strike. And then your return is your ending portfolio. So for these, for the first two, you have ending portfolio is 225, 298.52. Beginning portfolio is 200,000. Raise the 1 divided by 8. You can do that math, but you already know the answer. What's going to be the answer? What do you make if the stock market doesn't go up? What are the contracts said you're going to make? 1.5%. You already know that part, right? We calculated that here. 1.5% gives you 225. You start with 200,000. So obviously that's a 1.5% return. So that's no different. And that's true for the first two. So the only one we already calculated is the 341, 498.52 divided by 200,000. Raise the 1/8 minus 1. And I get 6.92%. But you can double check me on that one. I don't know how you put it in your calculator. I usually use the parentheses. Obviously, you can just raise it to the 0.25. That works as well. Or no, not 0.25, 0.125. Raise it to the 0.125. But you should be able to use a calculator, your parentheses, and do it to the 1 divided by 8. Is anyone getting 692? That look good? And then the S&P 500, here what you do, the same thing. Ending value, 870, divided by beginning value, 1450, raised to the 1 divided by 8, minus 1, and that should give you a loss of 6.19%. So same thing, your ending value is 870, you started with 1450, raise that to the 1/8 minus 1, and that gives you the minus 6.19%. This one's pretty simple because it didn't move, so you made 0% per year. And then this one down here, here your ending value is 2850 divided by 1450, raised to 1 divided by 8, minus 1. That should give you an 8.81% return. There's some important stuff here. Make sure you understand about this particular type of strategy because it's not really that fancy of a strategy. So the annuity made us 1.5%, 1.5%, and then at the very end, 692. The market made us 619, 881. The one thing I do ask on the exam, you'll see it in the practice, is I want you to actually graph these two things because you get a picture that's very, very famous. It may not be as symmetrical as I would like, but we're going to draw it. Any questions on any of this up to this point? It's not that difficult a problem. I don't know why 100% of the class doesn't make 100% on this, other than just exam anxiety or something. You have to do it in class, closed book with a calculator. So it's not open book. Students ask for formula sheets. I don't believe in formula sheets. Finance is formulas. So in my opinion, if a finance major asks for a formula sheet, that's like walking into the doctor and then pulling out an anatomy book because they can't remember which side the appendix is on. It's the same thing. Formulas is our anatomy for finance and actuarial students. So, and these are not hard formulas, right? These are pretty simple formulas. So you just got to know them. All right, let's see if Bill Gates is back up. No, Bill Gates is still crashing. I don't want it to take several minutes. I just want it to stop. All right. I knew if I threatened, it would go away. All right. So we got 0.015, 0.015. What was the other one? 669 or something? 660. How much? I can't hear it. Yeah, 92. Thanks. My hearing is really bad. So you almost have to scream at me. 881 and minus 6.19. All right, that's where the 9 was from. All right, let's see if Bill Gates will let me do this. Right, so it's not quite symmetrical. This should just be a straight line. So this orange line is the S&P 500. When the market falls, you lose money. The market's flat, you make nothing. The market's up, you make money. This is the equity linked annuity. When the market's down or flat, you have a guaranteed 1.5% return. When the market goes up, you get to participate. Okay. This point should always be below that point. If I could create this so it looked like this, would you ever buy the orange? Be no reason to, right? So you can't create that. That'd be magic. If you have something that can beat the market or equal it, the worst case it's equal, but on the downside, it has a guarantee. I wish I could create that. That'd be a wonderful investment. So you'll have to give up some here in order to produce this down here. What's producing this down here? That's that bond you bought that has that guaranteed 4.5% return. When you take the 50,000 and here, you've lost the entire 50,000, but at least you got enough here to get you the 1.5% return. So when the market goes up, so what does this look like? This is a few shapes. See if you see it in here. Not on that website. That doesn't look like it, does it? That's upside down. Why? Because you're selling an option. A married put, that sounds real friendly, but that's not exactly what we're doing. That's not it. That's not it. No, we're gonna do a short straddle later in the class. We talked about annuities, so we will look at a short straddle. Yeah, they're not doing the simple ones. Let me find another page. All right, here we go. All right, do y'all see it now? Protected put. What's the wrong with protected put? Your best case is you lose money. So not quite ours, is it? Real similar. Looks like that as well, doesn't it? You notice how the long call and the protected put look almost identical. That's why I said you could replicate this with a put if you wanted to. So there's two ways to do it. You put your money in the bond and you buy calls, or you put your money in the stock market and you buy puts. I set it up as a bond with calls, but you could set it up with the stock market with puts. Either one gives you a very similar, but you have to do it in a way that creates your worst case as a gain. And so that's what's not showing here. So, but that's a very, very famous structure in option strategy, is this downside protected with upside potential. So what does this sound like? Do you remember, Dylan? Put, call. I remember put call parity. Have y'all had put call parity before? I wonder if it's on the actual exam. So what put call parity says is there's a formula where the two sides of these formulas are mathematically equivalent. So they have to be the same. A C sounds like a what? That's a call. A P sounds like a what? A put, and an S is the stock. A protected put is when you own a put and the stock market. I could have done this equity linked annuity. In fact, both sides of these are an equity linked annuity. A put plus a stock, a call plus, what do you think that is? What did we do with our equity linked annuity? We bought a bond. That is a bond. The equity linked annuity, we own the call option and we own the underlying bond. Or we could have bought the stock market and bought a put option. These two have to be equal because at expiration, they're exactly equal to the penny. So they have to be the same, right? So we did it like this. And you'll notice with put call parity, this is the protected put. The call, the only thing that makes the call move is the call because the bond's is flat. So the call makes the shape. And that's why The protected put is not a put. Protected put's a put with the stock market. So a protected put and a long call, the shapes look exactly the same. The long call looks the same as the long call plus the bond because the bond's just a flat line. So you're just taking a constant number and adding on top of it. All right. This is what the put looks like by itself. That's not what we're drawing. That's not what you want, right? This wouldn't work because there you only make money if the market goes down. You want something that makes money when the market goes up. So that's why you have a protected put or the long call. All right. And there's some other pretty famous. Here's what we're going to do. The upside down straddle. And they get crazy, don't they? Yeah, there's our short straddle. We're going to talk about that. Yeah, some of them are just, they're getting a little too creative, but they're interesting strategies. So essentially what we're doing is we're taking advantage of the option market to give us some protection, but to get that protection, you must give up something. What are we giving up? We're giving up the upside. And this upside is going to get much further away as the market goes up. The two are just going to start deviating from each other. Right? So on the exam, you have to draw this chart. So how do you draw it? So what is my axis down here? My axis down here is, I can't remember, 870, 2850. So my y-axis is the S&P 500's closing value, 870, 1450, or 2850. And no, that's my X. I'm sorry. My Y is my returns. Minus 6%, 0, plus 8 point whatever percent versus the equity-linked annuity. So the equity-linked annuity, they're trying to create this hockey stick picture, which is a very, very common strategy in finance. It's a protected put. It's a long call. They're all very, very similar types. But we're going to buy enough bonds so that we can raise this floor above 0 and put it at 1.5%. And by doing that, it's going to kill this slope. If we didn't do that to get the positive, if we allowed it to go negative, we could get this blue line much closer to the orange line. But in order to create that positive return, we're going to start getting further away from the orange line. So there is no magic. There's no way to create upside without the protection on downside without giving up some of the upside. Now you can get fancier and fancier and fancier by selling more options out here or whatever. And there's ways you can do it. There is no perfect strategy. There are some very interesting strategies. Now, how does this strategy look today versus yesterday? So what's the most important to see if anyone from who else was in my investment class? Were you in investments or are you in P&C?
Well,
You're in both?
I was at one point.
Oh, it's some years ago. Okay. Y'all remember what drives the value of option prices? It's volatility. When the market's volatile, what do option prices do? They shoot up. When the market's nice and tame. So a few weeks ago, options were really cheap. This strategy we're talking about would have been a great one to execute it 3 days ago. What about today, though? Options are going to be much more expensive today than they were a few weeks ago. So, that's the downside of this. So the VIX, it's still not that particularly high, but it was below 15. When the VIX is below 15, options are fine. Let me get a graph here. So here's the VIX over the long term. I almost always buy options when the VIX gets down to 10. That's when insurance it's kind of like buying homeowners insurance. and there's a fire outside your house, and you call the insurance company, say, yeah, my house is about to catch on fire. And they, oh, you're in good luck. We're selling homeowners insurance at a discount, 2 for 1. So if your house burns down, we'll build you back 2 houses. And you're like, I just said there's a fire outside my house. Yeah, we got a special today. That's what I think about a low VIX. Why is the low VIX low? Because everybody's become real complacent. They're not worried about anything. That's when I think the world's the most dangerous. And that's also when the insurance is the cheapest. So I always buy, almost always, depends on how busy I am, but almost always buy options. Whether I'm buying call options or put options, it depends on what my view is. What about 2008? Would we have done this strategy right there? Probably not. It would have been ridiculously expensive. That $500 option might have been $2,000, $3,000. It may not have been worth it. The VIX got up to almost 80%. Now, I was at USA, the mutual fund board, they hired a professor from Rice University who was the co-creator of the VIX. And how excited I was to be on that, be presenting to that board. Really nice lady. And she sent me the file of all of their work, and then I forgot to take it with me. So it's still sitting on a computer at USAA. But what she did is she looked back at the VIX in the 1987 stock market crash, and the VIX actually went above 100 in that crash, which seems almost impossible, right? Because you can't lose more than 100% on the stock market. The stock market can't lose 120%, but the VIX actually got above 100. So that's what the VIX is. The VIX is the actual expected standard deviation of the stock market. So it should never be above 100 because you can't lose more than 100%, but it gets really, really high. This is when you want to be selling options. Now in 2008, we had a big debate. I had bought protection on our stock portfolio, and we actually met on this day. And my idea was sell all our options, get this massive gain that we had, and let's just invest in the market. My coworker was like, yeah, but options are so expensive. Let's short some options. He wanted to sell some put options and do some other things. I won the bet. And fortunately, the stock market shot up. And I was, I kind of was lucky on that bet. But he could have been right. We could have sold call options at a really high price and the market dropped more and we would have got to collect a really big premium. But fortunately, the market went up. But when the market does things like this, it's not a fun time to be an option trader because normal rollovers and those kind of things, they don't work in markets like this. There were some trades in that market were just absolutely insane. The market was completely misvalued. So don't see that too often. But even in COVID, you saw the VIX get up to 40. So a high VIX is above 20. You see it get above 20, especially above 25. That's a pretty high number. You can see how often does it get above 40? Obviously, here's the .com crash, 97 and 2000. 97 was kind of the pretend .com crash that didn't happen, and then it really happened here. Here's 2001, 9/11. I can't remember what, I guess that's the Enron and all that kind of stuff going on. And then since then, look how low. This is kind of amazing how low it's been. We had it back in the 90s when the stock market was doing nothing but going up every year. We did get a recession here, so it went up a bit. But you should have some sense of VIX and its level, what's normal. It is expected standard deviation of the market going forward. The historical standard deviation, the S&P is around 15 to 17%, depending on what time period. So below 15, it's too low. Above 17, it's higher than normal. But that's how you can tell when this number is high, an option strategy is going to be extremely expensive. When this number is low, so the strategy was looked at would have been incredibly strong, good strategy right here. You would have gotten a really good strategy. And if you went out 8 years, you would have avoided all of this loss and had that protection, and it wouldn't have cost you that much to buy the insurance. So you would have gotten a much higher than that 1.5% return. You probably could have guaranteed 2 or more. All right. If if you're not familiar with options, I'm pretty sure the actual exam must have something on options in there. It's got to be some indication, but my favorite place to go is the CBOE, Chicago Board of Option Exchange. And they have an education section with a lot of really good webinars and videos that they show you how to do stuff. There's option basics. So if you really want to get into it, that's a great way to do it. The other one is, amazingly, is Khan Academy. Khan Academy, if you use him, he has a bunch of 5-10 minute videos that go to the basics. So if you haven't had options, I would definitely learn them. You don't need to learn. You don't really need to learn option pricing to be able to understand options. So yeah, here's the option pricing model. It's not a horrible model. It's pretty easy to do in Excel because you're just using normal curves and just kind of, it's pretty easy to set up in Excel. But it's a long formula to memorize. I had it memorized for the CFA exam for part 2. I don't have it memorized today. So it's not something I know off the top of my head, but if you're buying options, you're not using the Black-Scholes formula. You're not buying options to try to figure out if it's mispriced. Options are rarely mispriced. You're buying option because you're worried about the market falling or because you think you see a stock that's really cheap and you want to, so you're buying options because of what you think about the underlying, not because you think the options rich or cheap. So if you want to learn options and you find yourself being steered toward a major study of binomial models or Black-Scholes, you don't need to go there. You really don't. You can just learn the base, just like what we have here. What are the basic strategies? This kind of thing, understanding what are they actually doing? Covered call, you own their underlying, you sell a call. Protected put, you own the underlying, you buy a put. A caller, you own the underlying, you own a put, and you sell a call. That's what you want to do. That's a strategy you need to know. Option pricing is not that critical. If you take speculative markets, that class that Brian teaches, he probably goes into option pricing models and theories and all the Greeks. It's good to know, but you don't need it for yourself as a personal investor. You can get away with understanding these strategies. All right, questions on? So the video, I haven't made it, I haven't looked at it in a while. Hopefully it's still working. So I just walk through it, but I do it by hand. Why? Because that's what you have to do. That's what you have to do on the exam. So I do it by hand. I write it out. So I can't listen to my voice, but that's what it does. All right. All right. So what we'll do, I don't want to start a new one. What we'll do on Tuesday is we're going to work on another one of these problems. All right. I might just show you the one from last semester. So it will be blank. It won't have all the work worked out. If you like, I can email your problem. You can work before class. If y'all would be interested in that, I can put it on Canvas. We can do that. So, all right, we'll do that. All right. Thanks.